Today's market moves weren't just about a modest pullback in equities. They reflected a deeper shift in how investors are reassessing the path of interest rates and inflation. U.S. stocks closed lower, led by a more pronounced decline in the Dow, while the S&P 500 and Nasdaq held up relatively better. At the same time, the more important move happened beneath the surface. Treasury yields pushed sharply higher, and volatility picked up, signaling that investors were beginning to hedge more actively. Commodities told a mixed story. Oil continued to climb, extending its recent strength, while gold declined despite the rise in uncertainty. Bitcoin moved higher, suggesting that pockets of risk appetite are still present. Meanwhile, credit markets showed early signs of strain, with high-yield bonds drifting lower. So what changed? The key shift came from the bond market. Investors are increasingly questioning how quickly interest rates can come down. Persistent inflation concerns, reinforced by recent central bank messaging, are pushing expectations toward a higher-for-longer environment. At the same time, rising oil prices are complicating the picture. Stronger energy prices feed directly into inflation expectations, making it harder for policymakers to ease financial conditions. In other words, the path to lower rates is becoming less certain. As these expectations shifted, capital began to reposition. We saw clear flows into energy, driven by both pricing power and its role as an inflation hedge. Technology showed selective resilience, but not broad strength, more a reflection of long-term growth themes than short-term optimism. At the same time, cyclical sectors like industrials and materials came under pressure. These areas are most sensitive to both rising rates and slowing growth expectations. What's more interesting is what didn't happen. Defensive sectors didn't see strong inflows. That tells us this wasn't a classic risk-off move. Instead, this looks more like a rate-driven repositioning, where investors are adjusting to tighter financial conditions rather than reacting to an immediate economic shock. And this is where some hidden fragility begins to emerge. Credit markets are starting to weaken. High-yield bonds are under pressure, suggesting that financing conditions are tightening, especially for lower-quality borrowers. Historically, credit tends to move before equities, so when you see this kind of divergence, relatively stable equity markets alongside softening credit, it raises an important question about how sustainable that stability really is. There's also a broader tension building. Equities are still holding up reasonably well, but they are now facing a headwind from rising discount rates. At the same time, growth-sensitive sectors are already reacting to slower expectations. So the market is not in a panic phase, but it is in a recalibration phase. The bigger macro signal here is that investors are adjusting their expectations around inflation and policy. Rising yields, weaker gold, and uneven equity performance all point to declining confidence that inflation will fall quickly enough to allow near-term easing. This is less about fear and more about acceptance. Acceptance that rates may stay higher for longer than previously expected. Now, one open question investors are debating is whether this adjustment is already largely priced in, or whether markets are still underestimating how restrictive financial conditions could become if inflation remains persistent. I'd be interested to hear how you see this. Is the market ahead of this shift, or still catching up? Looking ahead, the next phase will depend on whether incoming data reinforces or challenges this narrative. Inflation readings, in particular, will be critical. If price pressures remain sticky, yields could continue to rise, putting further pressure on equities. Labor market data will also matter, as continued strength could delay any policy easing. And of course, central bank communication will play a key role in shaping expectations. Energy prices are another variable to watch. If oil continues to rise, it could anchor inflation expectations higher, making this higher-for-longer dynamic more persistent. The broader takeaway from today's market reaction is that investors are beginning to recalibrate around a world of tighter liquidity and more persistent inflation. What this suggests for investors is not that markets are breaking, but that the underlying assumptions supporting them are being tested. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you find this kind of calm, analytical breakdown helpful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And thank you for spending a few minutes here today.